World headquarters in New York, I'm Julie Hyman.
And I'm Scarlet Fu. We're 30 minutes from the close of trading here in the U.S.
U.S. stocks are climbing in afternoon trading, although that is wavering to some extent. We've seen bank shares resuming a rally, though.
But the question is, what'd you miss?
President-elect Donald Trump's Attorney General nominee Jeff Sessions faces senators while the House readies its Obamacare repeal and replacement plan. We'll get a live report from Capitol Hill. Goldman Sachs is betting on machines. In the past, the firm has been skeptical of automated trading, but now it's trying to attract more quant funds after upgrading its technology. Plus, the biotech bounce. After suffering its worst year since 2001, the sector is roaring back in 2017, and Biogen has been among the leaders. We'll hear from the CEO on M&A this year and drug prices.
First, though, let's get a look at where the major indexes stand as we head towards the close. Bloomberg's Abigail Doolittle is standing by. Looks like we all just ticked into the positive.
You're right about that, Scarlet. Just moments ago, the Dow had been down ever so slightly, but as you mentioned, it is now ever so slightly higher. But for both the Dow and the S&P 500, these two indexes are largely unchanged, but right now higher after having periods of being slightly lower. But it's really the NASDAQ that's the star, on pace for yet another record close, the fourth record close in a row, the longest such streak since 1999. So some real strength for the NASDAQ. And a piece of this is the NASDAQ Biotech Index, up nicely today, up about 0.8% right now, up 6 days in a row. Now let's take a look at a few of the winners within the Biotech Index. First up is Sarepta Therapeutics, up about 23% right now, after the company did release sales data for its Duchenne muscular dystrophy drug, which was approved last year. There's a high short interest on this stock of about 18%. So some of this could be a short squeeze, with some investors thinking that that drug might not have done quite as well as it did in the short period of time that it was on the market. Now, Illumina is trading higher, in fact, on pace for its best day in 5 years, after the CEO, Francis D'Souza, at the J.P. Morgan Healthcare Conference yesterday said that they will be releasing a super fast DNA sequencer. And then finally, that might be helping Array Biopharma, but as did the news yesterday that Takeda of Japan is acquiring Ariad Pharmaceuticals for $4.66 billion. That really put a bid beneath many of the oncology biotech companies. And one question could be whether or not M&A could help biotech come out of a big bear market. We hop into the Bloomberg and we take a look at BTV 1944. This is a long-term chart of the biotech index. We have a beautiful uptrend, but back in the tech bubble, we see that a steep uptrend was broken by a period of consolidation, down 75% total. We also see that there was a relatively steep uptrend more recently over the last few years, and then into a similar area of consolidation. The question is whether or not that's going to break down. If it would be about a 70% total decline. So it'll be interesting to see whether or not M&A can help biotech. And helping to explain that area of consolidation, when we take a look at recent M&A action in the biotech sector, we have some very interesting data here out of the Bloomberg. We see over the last few years that when biotechs were climbing high and the prices of those stocks were pretty high, not a lot of M&A activity. But last year, in the heart of that biotech bear market, when these stocks could consider to be on sale, we see a huge surge in the biotech M&A activity. So perhaps this year we'll start to climb higher and maybe continue to keep the biotech bear market from at least getting worse, maybe even reverse it, Julie and Scarlet.
Yeah, it is interesting that underperformance was happening even as all those deals were happening. Thanks so much, Abigail. What'd you miss? As we just heard from Abigail, biotech and pharma companies spent much of 2016 under pressure from weak drug prices and higher R&D costs. And with the Trump administration promising lower taxes, conditions could be ripe for more M&A activity this year. The Biogen CEO is saying it's not in the cards, however. He spoke with Bloomberg's Eric Schatzker from the J.P. Morgan Healthcare Conference in San Francisco. He started by asking about how Biogen will invigorate the company's pipeline.
The core of the mission of our company is science and innovation, and mostly in the field of neuroscience and neurodegeneration. And actually, this is why I joined the company. I have 25 years experience in the industry. It was basically the first time I could see a company with such a depth of portfolio in such an area of huge unmet medical need, neuroscience and neurodegeneration. This is where the epidemiology is going. So obviously there is a strong pipeline. You're aware about our candidates, mostly for Alzheimer. but good is never good enough. So the objective is even to go and try to bolster the candidates that we have so that we can meet even better the unmet medical needs moving forward.
So to understand what you're saying, your preference is to bolster what you already have as opposed to going out and getting something different?
I think we have to do both. This is the name of the game. We are very confident in the significant talent that we have in-house and the ability to be productive with our inner pipeline. But there is a lot of stuff going outside also, and we need to be in a position to partner, attract or acquire some molecules or some companies in order to come and complement the core. Neuroscience will be the focus. This is where public health is mandating the industry to come and meet unmet medical needs.
So there are many competitors of yours who also want to find those partnership candidates. So it's very expensive, or at least it's very competitive. You mentioned the possibility of acquiring. That too is competitive. Do you have parameters for what you're prepared to spend to get where you need to be?
The first parameter is that the foundation of the company is solid. The financial results are solid, and the past, the track record speaks for itself. So we'll be very methodological, we'll be very rigorous on how we allocate capital for the best return to shareholder. We won't do that in a haste. There will be no panic action. We will do that the best way.
Is there a limit on how much money you're prepared to spend?
No, we'll be focusing on science, and then we will look into the financials. I think this will be the driver.
What about pricing? You know it's a thorny topic, particularly here in the United States. You recently said that Biogen will not rely on price increases to drive revenue. Then the company goes and raises the price of one of its leading multiple sclerosis drugs by 8%. How do you reconcile those two things?
So price remains one of the key mix that we have to be managing with a lot of care. I will say even more moving forward. At the end of the day, it's value that determines what we bring to the market and how the companies need to be remunerated.
I do, however, and I think I'm going to re-ask the question. How do you, on the one hand, say we're not going to rely on price increases and then raise prices?
Well, the demand generation is what we should do first in order to assess basically the results of the organization and the ability to implement well. Nevertheless, in some markets like in the US, we are able to take a reasonable price, and this is what we have done. It doesn't mean that this will prevail forever. I think that the industry needs to revisit the way we engage with third parties and PBMs moving forward on the contracting. And I'm not sure that taking price will prevail forever.
So what do you mean by redefine that relationship with the pharmacy benefit managers?
I think that qualitative measures and value creation and towards the aim of the healthcare reform and outcome and value-based contracting should be something that gradually the industry needs to look into.
Does that level of engagement exist now?
Not really. We have seen.
So it's years away?
Not necessarily. You have some examples now from other companies. I'm not sure this has been always strategically designed, and it's not easy to put together because you have different actors that need to come along.
So in the meantime, I have to ask before we run out of time, can you stand up to the pharmacy benefit managers? What can you do to fight back in the meantime?
So what we do with the PBM is that we partner very well, and whatever we have done, including the price increase, was done working together with the most important PBMs around the country. And this has been in line with a concerted effort of engagement together with the PBMs. We are very careful on price. This is a very important topic, and your question and pushback is very fair.
That was the CEO of Biogen from the JP Morgan Healthcare Conference in San Francisco.
Coming up, China's factory prices rising at the fastest rate in more than 5 years. We're going to take a look at how this could affect foreign direct investment with an expert on the subject, Michael Enright. From New York, this is Bloomberg.
What'd you miss? China's factory prices rose at the fastest pace in more than 5 years in December. This comes as the factory to the world swings from being a drag on global inflation to another potential force pushing prices higher. The data rippled across markets. It pushed up an ETF tracking Chinese shares. It has helped support copper prices, among other effects. Joining us now for more on the Chinese economy is Michael Enright. He's managing director for Enright, Scott & Associates. It's an economic and strategic consultancy. Michael's also an author, and his latest work is called Developing China, the Remarkable Impact of Foreign Direct Investment. We'll get more to that particular topic in a moment. Michael, welcome. But let's start with the PPI number. Consumer prices a little more muted in China. How sustained, then, do you think that this lift in wholesale inflation is going to be there?
Well, it's the first sign in a long time of a rebound in manufacturing. Of course, we've seen declining prices over the last couple of years. But at least among my client base and in my context, they are seeing a bit of a rebound in domestic demand, a bit of a rebound in global demand, and that's what's feeding into the prices. So at least in the short run, a pretty good sign both for the Chinese economy and the global economy.
And we do have a chart, by the way, of PPI versus CPI, just to show that consumer prices have been sort of stable, but not going up very much. The zero line is down here. And as you say, there hadn't been much sign of factory inflation until very recently. So when you look at the other sort of economic tea leaves in China, are you seeing them support this sort of gathering strength in the data as well?
Well, it's hard to say because it's been quite a recent uptick. And we've seen, of course, over the last year or more, growth in China slowing. We've seen pressure against foreign companies and some of them rethinking what they're doing in China. We've seen consumption be pretty stable, as your consumer prices would indicate. And it's really been an issue of what's been going on in the global marketplace and China's export performance that has added to the volatility on the manufacturing side.
You mentioned foreign companies rethinking their plans in China. Does rising PPI, rising wholesale inflation push them to do something sooner rather than later?
Well, what it does is it prevents them from thinking about cutting back, because what we've seen, again, over the last year or two now is slowing growth in China, and also as Chinese companies themselves become much better competitors, a tougher competitive environment. And when you combine that with, again, the well-reported examples of there being some pushback against foreign companies. Perhaps China's starting to think that it doesn't need the foreign companies or foreign investment perhaps as much as it did in the past. Those three things together have caused some companies to start rethinking. But I think that this sign, again, if it sustains, would be an indicator that the market's starting to come back or at least stabilize in a way that producers will, of course, welcome.
Now, you've quantified that foreign companies and foreign investments generate about 1/3 of China's GDP, which took me by surprise. At least in recent years, that's been the case. Is that a good thing from Beijing's perspective? Is that where they want the level to be?
Well, I think it's actually a sign of two things. It's a sign that even though foreign companies, foreign governments have been very frustrated with the limited opening in China and with the slow pace of opening, that the reality is that foreign investment has been huge in China. The cumulative investment since China started to open is about $1.8 trillion US. And even though today foreign direct investment last year, for example, would have only been about 2% of gross capital formation, if you take the combined effect of the investment itself, the operations of the foreign invested enterprises, many of whom have been there for decades now, the ripple effects through the supply chains, which has vast spillovers for domestic companies, plus the consumer spending of all the relevant employees, we get that to equal about 1/3 of China's GDP. And that doesn't take into account technology spillovers into Chinese companies, foreign companies providing Chinese firms with access to global capital markets, foreign foreign firms introducing world-class sustainability, CSR practices, business practices in general, and not to mention even the hundreds, if not thousands, of spin-offs, indigenous firms that have been started by former employees of the major multinationals. In our view, those impacts may be as important, if not even more important, than the ones we can quantify.
Now, we haven't talked about the president-elect yet. Obviously, there's been a lot of talk here in the U.S. about the relationship with China, both politically and economically. What are you hearing from the Chinese? You're based in Hong Kong. What are you hearing from the Chinese and Hong Kong perspective? How concerned are people about the relationship and what the effect will be of the incoming administration? There's concern, but also caution of not to move too quickly. In other words, we have not seen what policies will come out of the U.S. Under the new administration. In the U.S., the president actually has substantial power to impose trade restrictions under existing law. No new legislation has to be passed to do that. And so I think the view in China, and certainly the view in Hong Kong is very straightforward. More trade is always good for Hong Kong, regardless. In China, China has different priorities. Economic development and trade is one, but its geopolitical status, its ability to project itself as a strong nation willing to stand up to others is equally important, if not even more important.
So what is China's priority if you've got this change in leadership, or at least the meeting to discuss leadership changes in China later this year? We know that Donald Trump has been doing some saber-rattling with his phone call with the president of Taiwan and tweeting about it. But how does it look from the Chinese perspective? What kind of machinations might we expect from Xi Jinping?
Well, I think, again, I think there's uncertainty because just as here in the U.S., I think there's a lot of uncertainty, certainly even more uncertainty in China about exactly what policies will be followed. Chinese officials are well aware that some of the advisors and cabinet appointees have been relatively hawkish on trade. And what's also interesting is that while U.S. corporates in the past have in many ways been the major defenders of China when it comes to discussions about trade in the U.S., given the fact, again, that a number of them have experienced a sort of pushback against foreign companies in China, they're maybe not so concerned or not so disappointed with the U.S. government perhaps taking China to task on the trade as well as investment relationship.
Okay, I want to end it where we began, which is with the data. How much do you trust the data that comes out of China, whether it's PPI, whether it's CPI, whether it's GDP? I mean, it may be distorted, but is it consistently distorted?
Well, I think you see a lot of earnings smoothing or the equivalent in China. The data is better than it used to be, that's for sure. In the command economy days, of course, you could produce 100 tractors and it went into GDP even if nobody needed the tractors. The data is getting better. The last time that we saw a lot of concern about the numbers being overstated, China then did an economic census. This was about 10 years ago, and found that the economy was understated by about 17%. So it's probably slowing a bit more than the Chinese officials are letting on or would like. Which is another reason why perhaps they should open more to foreign investment rather than close off. But our view is that the numbers are reasonable. The aggregate numbers seem reasonable. Because these days, as more and more of the Chinese economy is taken up by the private sector, you actually have in many ways as much incentive to underreport as you do to overreport.
All right, Michael, thank you so much for coming in. It was good to hear your thoughts on the Chinese economy and the relationship with the U.S. Michael Enright is Managing Director of Enright, Scott & Associates. He's author of Developing China, The Remarkable Impact of Foreign Direct Investment. Well, up next, we're going to talk biotech with a chart showing you how the industry has started this new year. This is Bloomberg.
Fu. What you missed, one of the data points today that came out was small business optimism. And here you can have the white line, or you can see the white line, and that bump up in optimism among small businesses. If we go over here, Matt, you can see the move in December was particularly noteworthy, not just for the size of the move, but where it stands. This was the biggest gain since 1980 to the highest level since the end of 2004. Now, the blue line is the Russell 2000, the small cap index, and you can see that correlates nicely with the small business optimism index. What's interesting, of course, Julie, is that on Friday, at the end of last week, we saw the Dow, S&P, and NASDAQ make record highs, but the Russell 2000 did not join in the party. It had been now a month since the Russell 2000 has made a record high. So is it a laggard? Is it a leader? It's not clear.
Right. It had been a leader, right? Post-election, we really saw small caps, which tend to be more domestically oriented, outperforming, and then that outperformance has sort of stabilized, if you will.
And Tom Lee of Fundstrat was saying he actually sees the Russell 2000 correlate more with high yield. And so high yield is showing some signs of caution, perhaps some trepidation before the administration takes office. And so that might be a leading indicator in the end for equities.
Interesting. One of the other groups that's been in focus that Abigail talked about earlier, I know you're going to talk about a little bit at the close, is biotech. That JP Morgan healthcare conference has been going on, and biotech had been a laggard post-election. It was also a laggard last year, falling last year and having the worst year since the inception of the NASDAQ biotech index. That's what we're looking at here. So 2016 is the blue line. You see the declining performance there. But in 2017, the white line, we're actually showing a strong start to the year, the strongest start, in fact, since 2015. So a rebound here for biotechs. As Abigail talked about, mergers and acquisition activity is fueling that to some extent. There are still a lot of question marks, though, Scarlet, about the year, about the drug pricing debate, not just drug pricing, but Endo Pharmaceuticals, for example, down sharply today on scrutiny of one of its painkillers. And there is likely to be more of that to come.
Yes, absolutely, especially with Donald Trump being very vigilant on drug pricing going forward. We'll expect that to be the case as well. All right, coming up, you've got the market close. Take a look at the major indexes with less than 4 minutes to go before the close. The NASDAQ setting another record high. The S&P 500 has resumed its advance, albeit a small one. The Dow inching down by 20 points, 19,867. From New York, this is Bloomberg. We're moments away from the closing bell. What'd you miss? We have some breaking news. JP Morgan, or former JP Morgan, Citigroup, and Barclays traders were charged in an FX probe. So again, this is a cartel group, currency traders, charged in a market rigging case. Richard Usher, one of the names, Rohan Ramchandani, formerly of Citigroup, and Chris Ashton, formerly of Barclays. We'll give you more details as they emerge. In terms of the market close, you heard the closing bell there. U.S. stocks are racing the gains that took the S&P 500 towards an all-time high. Post-election asset moves stalling a bit here. The day before, President-elect Donald Trump is slated to hold a news conference that could shed light on his policy preferences. I'm Scarlet Fu.
I'm Julie Hyman. Welcome to our viewers who are tuning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern.
We begin with our market minutes. Another record high for the NASDAQ. It was the only one to set a new high. The S&P 500 resumed its advance. The Dow closing down about 32 points. We don't have a whole lot of economic data at the start of this week. Most of it comes at the end of the week.
And today really felt more like a session that was driven by individual company news, more so than any kind of big macro factors driving trading overall.
And I'm glad you bring that up, because if you come inside the Bloomberg here to take a look at the sector performance, the sector breakdown, we've seen a little bit of a switch here. Earlier in the day, healthcare was leading the way, but at the end of the session, you have consumer discretionary, which includes retailers, home builders, and auto companies gaining
and Chipotle.
And Chipotle, yes, thank you.
Which was up today.
Up 0.4%. The laggards here are energy companies because of oil price declines, and real estate off by 1.3%. I do want to highlight, however, the healthcare sector, because Julie mentioned earlier biotechs having this incredible start to 2017. XLV is the healthcare select sector spider that tracks the industry, up a third of 1%. Illumina up by 17%. News of a new DNA sequencer at the JP Morgan Healthcare Conference.
That one was, I got to say, that's the cool story of the day. They can sequence your gene in an hour.
This is big news for our healthcare investors, and the stock is up 17% on the day. Zimmer and Boston Scientific, these are both medical device makers. Perhaps with Congress taking up the repeal of Obamacare, they're also in the spotlight as well.
I think Zimmer came out with some preliminary earnings, too, that topped estimate, preliminary sales topping estimate.
Thank you.
So that helped that stock as well. Let's get to the bond market as well. We did see the sell-off resuming today, but not in very decided fashion. Again, here, no big macro factor driving trading. We saw yields bumping up a little bit, just a basis point really across the curve. We did have a 3-year auction, however, today that drew the highest demand since August. So some of the auctions we've seen in the bond market recently have been a little firmer. And as we saw this movement today, a little bit of re-flattening of the yield curve to some extent. So come inside the Bloomberg. I'm taking a look at #BTV 4726. This looks at the 5 to 30 spread. That's the white line, and the 2 to 5 spread, which is the blue line, which had sort of widened out. And now it's coming back in again just a little bit.
Yeah, it's something that a lot of analysts have brought up time and again in recent days. In currencies, the dollar tracking the move in treasuries. Dollar-yen actually moving very closely with the 10-year yield. Lots of choppy trading in FX really before the news conference by President-elect Donald Trump, where everyone's going to look for some kind of clue into what he's going to set as policy. Speaking of policy, a lot of question marks over what Brexit might look like. The pound extending its sell-off to a third day. HSBC strategists led by David Bloom predict that the pound could drop to as low as $1.10 if the most severe Brexit option is pursued. And if you come inside the Bloomberg here, what you'll see is that the British pound is the worst performing G10 currency versus the dollar so far in this very young new year. It's off by 1.4%. When you expand it to the majors, as Julie pointed out earlier, the Mexican peso has done worse, off by 5%. So clearly the central bank intervention from Mexico not doing a whole lot to lift the peso from its record low. And according to strategists, the central bank's dollar sales is neither sustainable nor likely to work. So maybe throwing good money after bad.
Let's get to commodities as well. Some really interesting moves going on today. There's all this optimism, or there was all this optimism about OPEC nations cutting as they had planned. However, Bloomberg uncovered some data on exports from Iraq today that seemed to indicate that perhaps Iraq was not cutting production election as much as it is reporting. And so that caused or helped contribute to, at the very least, a decline in crude prices, tumbling by about 2%. Copper, on the flip side, being helped by that economic data out of China that we discussed earlier, with factory prices expanding at the fastest pace in 5 years. Gold futures continuing their little bounce here, their little winning streak that we have been seeing in the past several weeks, up just about 0.25%.
Those are today's market minutes. We want to take a deep dive now into the Bloomberg. You can find the charts using the function at the bottom of the screen. And I'm glad you brought up China and the PPI data again, because I have something that combines that with commodities. Of course, the orange line shows PPI fastest pace in more than 5 years, 5.5% gain in December. Factory deflation seems to be dead. It's been 4 months since we've had falling factory prices. Rising commodity costs are helping to drive that. So the white line is oil prices, up 52% year over year. The blue line is iron ore, and it's up almost double, 98% during the period. So the weaker yuan is helping to push up these input costs, and all of this is contributing to pressure on prices. We talk a lot about how China exported deflation the last couple of years. The question now is whether it can export this inflation and feed the global reflation story.
Well, and certainly there are inflation pressures elsewhere, also independently of what's going on with China. So it's all sort of combining. As you look at things that are moving together, I'm looking at things that are moving apart. Dispersion has been a big theme since the election that we've talked a lot about in the U.S. stock market. So this great chart, brought to us by our very own chart producer, Dan Curtis, the bottom line here, the purple line, looks at the pre-election spread between information technology, the best performing group going into the election, and telecoms, the worst performing group. So even though you have the best to worst, the spread is not that wide, right? You're talking about 12.5 percentage points. Post-election, if you look at the worst to best, best to worst, financials versus consumer staples, the white line, you're looking at a 20 percentage point spread. So indeed, this is just a real example of the dispersion that we are seeing in the U.S. stock market. As many folks have said, going into 2017 is a stock picker's market. This is perhaps evidence that that is indeed the case.
Active managers are all cheering around the world. This is a great chart, by the way.
It is a great chart, Dan Curtis. And now I want to get thoughts about this divergence between stocks and bonds as well. Sanford Bernstein strategist is saying that that divergence is about to end, and the traditional allocation of 60% stocks, 40% bonds is going to be risky going forward. Bloomberg's Mike Regan, he's senior editor and lead blogger for Markets Live. So we've always sort of considered this allocation. That's the standard allocation. Is it time to give it up?
Well, this Bernstein strategist, first of all, this report is a real page-turner for market nerds like me, because he looks at the correlations going all the way back to the 1700s and finds that, as you might expect, stocks and treasuries are historically positively correlated, which makes sense. As treasuries go up, yields come down, interest rates come down. It's good for stocks. Borrowing costs come down. The interesting thing is, in the last decade, they've actually been negatively correlated, which intuitively doesn't make a lot of sense, because they both have performed very positively over the last 30 years, have positive returns. But there's been enough areas of divergence that stocks and treasuries are negatively correlated. And the question is why? And according to the Bernstein strategy team, it's because, as that chart you showed earlier, deflation was such a concern before this year, before the inflation started picking up, that that's obviously bad for equities. If prices are going down, that's not going to be great for corporate profits. So any pickup in bond yields, any fall in treasuries that caused a pickup in bond yields tended to have a lifting effect on the stock market, because it made people think, well, this deflation bug that we're fearing is going away. Well, now that inflation looks like it might normalize again, that we might get this pickup to a more natural rate of inflation, Fraser Jenkins is saying, well, that could very well cause the stock and bond correlation to turn positive again. And so this 60-40 allocation, which had been very good for the last few decades because it was diversification. If stocks started tanking, then you still have the treasuries holding you up. If they're positively correlated going forward for the past 10 years, that's going to be tricky for pension funds and anyone else that needs that income and is relying on stable returns returns going forward, because with bond yields starting off from such a low point and from equity valuations starting out from such a high point, a Shiller P of 28, he's saying that, it's the opposite of the way the stage was set in the 80s when this bull market in Treasuries started. We had low equity valuations then, high interest rates, so it was a natural that Treasuries would rally and stocks would rally, and the reverse is true now. So it's not necessarily a big bearish thing for either asset class, but he's saying, expect very low returns, maybe 5% a year in stocks for the next 10 years and 2% for bonds.
So is this good news or bad news for those active fund managers, the stock pickers?
Well, like Julie said, everyone, I'm reading a lot of notes now saying the return of the stock pickers here. However, I've read these reports for years now. I'm sure
Yes.
we all have. Just like you read, option strategists saying now's the time to buy options. Call our desk. The lines are open. That said, I do think the stage is set. The conditions are there with this type of dispersion, with so much going on other than this focus on central banks. And not just for stock pickers. Cameron Kreis on our team has been joking that, this Trump election is really making macro great again, meaning, it's now going to be, there's more potential to trade rates and currencies and stocks because, there's a lot more going on. There's a lot more ways to analyze and sort of place your bets rather than just fixating on central banks on what their next moves is going to be.
It sounds like there's something in it for everyone.
Well, that's what we hope. So
counterintuitively, could we actually see? If there is sort of a piece of bullishness in the incoming administration and the economic backdrop for everyone, could you actually see an increase in correlations then, not just between stocks and bonds, but the dollar's going up as well?
Right. Asset classes.
Yeah, could
Right.
you see that more broadly?
Right. I think the hope is that the correlations that existed in sort of the Fed-dominated regime have shifted now, and everyone's trying to suss out the way it is now. Obviously, with the dollar going up and stocks going up, that's a bit of a head scratcher. A lot of people worrying about when that dollar strength will start to bite back on corporate profits. Fraser Jenkins at Bernstein also talking about this populism and the sense that labor will exert a stronger influence. That's going to cause profits as a share of GDP to put some pressure on that ratio. So, and that's not necessarily a good thing for stocks. So there's a lot going on. Again, the stage is set for active managers to really dig in and do well. But will they perform, and will it sort of stop this trend? This massive trend of indexing is yet to be seen. It would really have to show some strong performance to really reverse that type of trend.
Yeah, performance which we have not seen recently. Mike Regan, Bloomberg's senior editor and lead blogger for Markets Live. Thanks so much, Mike.
Coming up, we'll get you caught up to speed, I should say, on the biggest political stories in the headlines. Of course, Senator Jeff Sessions' confirmation hearing. There he is wrapping things up right now. And the latest on the Republicans' efforts to repeal Obamacare. This is Bloomberg.
Lisa Parenti. Let's get to Bloomberg's First Word News. President-elect Donald Trump's nominee for Attorney General is strongly denying allegations of racial animosity that derailed his federal judicial nomination 30 years ago. At his confirmation hearing today, Alabama Senator Jeff Sessions called the accusations false.
This caricature of me in 1986 was not correct. I had become United States Attorney. I supported, as the civil rights attorney said, major civil rights cases in my district that integrated schools, that prosecuted the Klan.
Sessions says he hopes this week's hearing will show that he conducted himself, quote, honorably and properly at the time. He's set to testify for a second day tomorrow. Robert F. Kennedy Jr. says he's accepted President-elect Trump's offer to chair a committee on vaccine safety and scientific integrity. After their meeting today, Kennedy, a vocal vaccination skeptic, says the president-elect is very thoughtful.
President-elect Trump has some doubts about the current vaccine policies, and he has questions about it. He says his opinion doesn't matter, but the science does matter, and we ought to be reading the science, and we ought to be debating the science.
In 2014, Trump tweeted that he believed there's a link between vaccines and autism. That is a claim denounced as dangerous by many doctors. And President Obama makes his farewell speech tonight, but he won't be speaking at the White House. The president will instead deliver his address from his adopted hometown of Chicago. And you can watch President Obama's speech tonight here on Bloomberg TV. Coverage starts at 9 p.m. Eastern. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. Scarlet?
Thanks, Elisa. What'd you miss? As we've been reporting, a flurry of confirmation hearings kicked off today on Capitol Hill, beginning with Jeff Sessions, the nominee for Attorney General. Let's get the latest now from Capitol Hill, where Bloomberg's Kevin Cirilli is standing by. So, Kevin, contentious hearing, and it kind of got off on a rocky start. Give us your highlight. What were you most surprised by in today's hearing?
Contentious is an understatement. Several protesters interrupting Senator Jeff Sessions' hearing here on Capitol Hill to lead the Department of Justice. You know, Democrats continuously brought up previous racially charged statements that Sessions has made from his decades of experience years ago in the Senate. But Republicans, if you're a Republican, you're feeling pretty good about how today went. They kept advocating that Sessions would help restore the country to law and order. And they defended him from having the criticism from Democrats pour into some of their votes. But, you know, I put the question to Sessions spokeswoman Sarah Isker Flores about whether or not Sessions would weigh in on the AT&T Time Warner deal. And what she told me was that he would defer that to the leader of the Assistant Attorney General at DOJ with regards to leading up the acquisitions and mergers section of DOJ. So, you know, if you're in the business community and you're watching today's hearing, the takeaway is that Sessions will not be as critical of this deal or of other mergers and acquisitions as President-elect Trump has been. In fact, I heard from his spokeswoman that Sessions did not speak to Trump at all in their meetings about Time Warner and AT&T specifically.
Oh, very interesting stuff, Kevin.
Yeah.
In terms of his testimony itself, were we able to glean perhaps what some of his priorities will be, presuming that he is indeed confirmed?
Immigration. And in fact, he was one of the first senators to support Donald Trump at a time during the presidential campaign when, quite frankly, many folks were wondering if there was any support in Congress for Trump. And immigration has been Senator Sessions' key policy issue while he has been in the upper chamber. In fact, one of his former top staffers, Stephen Miller, actually left Sessions' office to join the Trump campaign and is now Trump's senior policy advisor. So he received many questions from both sides of the aisle today about his immigration policies, of course, border security. He also talked about the Muslim ban. He said that he would not support an entire ban against a religion, but that he would support Trump in advocating for more stringent policies in coming from terrorist countries, advocating for more stringent vetting policies. So clearly making that distinction. Candidly, observing him on the campaign trail as a surrogate for Trump, this was a much more tepid, a much more measured Jeff Sessions than what we've seen in the past year and a half.
All right, good wrap up. Thank you so much. Bloomberg's Kevin Cirilli joining us from Capitol Hill.
And now on to another political story today, Obamacare. President-elect Donald Trump said Republicans should repeal the health care law immediately. That's despite a faction of Senate Republicans who are trying to delay the effort until March. Here now with the latest is Alex Wayne of Bloomberg News. He is in our Washington, D.C. bureau. So, Alex, you know, this was sort of a foregone conclusion at one point politically that the ACA was going to be out. And now it's really a question here. What happened? What changed?
Maybe some people thought it was a foregone conclusion, but I'd observed that when Democrats got the Affordable Care Act passed back in 2009 and 2010, they had 60 votes in the Senate, and they needed every single one of them to get the thing through. To think that it'll get repealed easier than it was passed when Republicans now only have 52 votes in the Senate, I think was wishful thinking.
Go ahead.
So what's happening here is that Republicans in the Senate, people we would now call moderates, I suppose, are realizing that if they repeal this law without any consensus policy to replace it, they risk jeopardizing insurance coverage for millions of people, including people in their states who might vote for them.
And what kind of tone has Donald Trump himself set for the treatment of Obamacare? I mean, he has warned about a quick repeal, breaking something before having a replacement figured out.
He's been very inconsistent. On Twitter last week, he cautioned Republicans to move carefully, to let the collapse of Obamacare dangle around the necks of Democrats. He almost suggested that Republicans could do nothing and the law would collapse on its own. Then today, he told the New York Times that it should be repealed immediately, virtually the day he's in office. So it's a little hard to tell where he stands on this issue. And I imagine his colleagues in the Republican Party in the Senate are also having a little trouble determining where he stands on this.
And there's also the question of where he stands on vaccines, and they're linked to autism, which has been debunked. He's appointed Robert F. Kennedy Jr. to this panel on vaccine safety. Does the panel already exist? Is it already something that's being examined, or would this be a new effort?
No, I'm not aware of any kind of vaccine safety panel existing in the U.S. government. It's very unclear what the president-elect expects this panel to do or who he expects to sit on this panel. Robert F. Kennedy is a guy who doesn't have very much credibility, I would say no credibility in the scientific community on the issue of vaccines. There's nobody credible who's going to sit on a committee led on vaccine safety led by Robert F. Kennedy. So I don't expect this panel to be to accomplish anything, but I do think there's a danger that by raising this issue, Donald Trump could encourage the idea that vaccines are unsafe. And that could lead to parents exempting their children from getting their shots, which they should do. Children need these vaccinations. They save millions of lives a year. They are overwhelmingly safe. They have many more public benefits than any harms.
All right, well, we'll see how that all plays out. Thank you so much, Alex Wayne of Bloomberg News. And you can turn into Bloomberg TV and radio tonight at 9 p.m. Eastern Time. That's for complete coverage of President Barack Obama's farewell address. Also tomorrow, President-elect Donald Trump will be holding a news conference at 11 a.m. Eastern Time from Trump Tower. Very busy political time.
Yeah, highly anticipated news conference at that. Coming up, what can we expect from gold in early 2017? We'll walk you through one of the most popular functions here, plotting gold's seasonal performance. This is Bloomberg.
In San Francisco.
I'm Scarlet. What'd you miss? Let's take a deep dive into the Bloomberg. You can find our charts using the function at the bottom of the screen. Gold is consolidating after some recent gains, but if you look at how it's done since mid-December, up almost 5%, holding near 6-week highs. So I wanted to check if that's been the case every year, and it turns out it has been. This is a heat map, so you can find it by doing by typing in GC1 commodity. SG for
SEAG.
SEAG or SG. It's a shortcut. Yeah.
I can do it shorter.
There you go. So there's a lot of anticipation and evidence of Asian buyers stepping up their physical gold purchases before the Lunar New Year, which occurs this year on January 28th. It'll be the year of the rooster. January is clearly gold's strongest calendar month. You can see here there's an average monthly gain of 3.8% over the last 10 years. And in the past decade, there's only been 3 instances, 2013, 2011, and 2010, in which gold has declined. And you can see that previous to that in December, a lot of red there for that period. And it's also the case for, obviously, the last 5 years, which you could just see a little bit more in better detail here. Here's the gain over the last 5 years. So it's been consistent for the last 4 years, certainly, of gains in January.
Now, as we're talking about politics just a few moments ago, a chart caught my eye that had to do with this debate with Mexico about keeping jobs here, not automakers not building plants in Mexico. So there was this great chart on the Bloomberg today, which you can find at #BTV2191, that looks at U.S. employees who are employed by the manufacturing industry. That is that purple line, and they keep rising. Employment in manufacturing kept rising in the U.S. even after the start of NAFTA. So presumably the Mexico effect was muted there. The other 2 lines, by the way, are the imports from Mexico and exports to Mexico with the U.S. You really saw that manufacturing employment start to roll over when China entered the World Trade Organization. So what this chart suggests is that China was certainly a bigger factor on that effect on the U.S. manufacturing industry than was Mexico. Automation, of course, is also a significant part of that.
Which all happened around the same time.
Yeah.
All right, coming up next, we'll take a look at the current bond market through the lens of nearly 800 years of economic history. This is Bloomberg. This is Bloomberg. Let's get a recap of today's market action. We're looking at the NASDAQ closing up for a 6th straight day, setting yet another record high. No change there for the S&P 500.
You don't see that very often.
Yeah, so I guess it's settled with absolutely no change. The Dow, meantime, inching lower by 32 points, moving away from that 20,000 mark. Tom DeMark, noted technical analyst, chartist, had said that he did not think the Dow would ever get to 20,000, at least in this cycle, or close above that level, or even get there on an intraday basis. And it's kind of playing out, at least early this week.
I am going to have to ask somebody when the last time is that the S&P did not move at all. Wow.
It is pretty remarkable.
It is pretty remarkable. Okay. We're also watching in terms of market activity. Jeff Gundlach of DoubleLine is just beginning an investor webcast. We'll bring you headlines from it. The only headline thus far is a comment on oil. He says he expects oil to vacillate in the $45 to $55 range in 2017. Again, looking at that $45 to $55 range in 2017. Gundlach, a lot of folks pay attention to what he says. DoubleLine Capital has been one of the most rapidly expanding and now one of the largest bond shops after he left TCW several years ago now. So we'll bring you more headlines on his commentary from that webcast when we get them.
Meantime, what'd you miss? U.S. prosecutors have charged 3 ex-traders with currency rigging. Richard Usher, formerly of J.P. Morgan, Rohan Ramchandani, formerly of Citigroup, and Chris Ashton, formerly of Barclays, used an online chat room that they dubbed the cartel to coordinate the rigging of foreign exchange benchmarks by sharing confidential customer information. These charges stem from the currency rigging story that Bloomberg News first broke back in 2013. Joining us now with more is Bloomberg's David McLaughlin in Washington, who got the scoop. Congratulations, David, on your reporting. So give us the update here. What is the new information? What is the latest development on this?
Well, so as you said, Bloomberg broke this 3 years ago almost, and today is the indictment of 3 of the key players in this alleged conspiracy. They worked at major banks, and so from roughly 2007 to about 2013, they were using this chat room to coordinate their trading in fixed prices and the trading of euros and dollars. And this comes about a year after a group of banks had to plead guilty for this conduct. So this is the first, though, big development in terms of charges against individuals.
And do we expect there to be potentially more?
I think that's somewhat unclear at the moment. Just last week, the Justice Department charged a former trader at Barclays with trading other currencies, and that was the first indication that they were looking at, that the government's been looking at the trading of currencies besides the euro and the dollar. So that was some indication that this might go beyond just this cartel group, but we haven't heard from actually DOJ about this case and whether they're looking at other traders.
All right, Bloomberg's David McLaughlin, thank you so much. Appreciate it for that reporting on the arrest of those 3 traders. What'd you miss? A gloomy prognosis for bonds. Paul Schmelzing, a PhD candidate at Harvard University and a visiting scholar at the Bank of England, said if the latest bond market bubble bursts, it will be worse than in 1994 when global government bonds suffered the biggest annual loss on record. He joins us now from London to discuss. Paul, thank you so much for joining us. So obviously we have seen already the bond rout that happened sort of in November, I guess, was at its most intense, October, November. What do you see when you look at historical perspective that indicate that we could see the makings of a really more severe bond rout?
Well, Julie, the last 35 years really constitute one of the most remarkable periods in economic history for the global risk-free asset. And you really have to go back to the 15th and 16th century to find similar bond market rallies in terms of yield compression, in terms of sheer length of the bond market rally than what we've seen since 1981, since Paul Volcker declared war on inflation after the oil shocks. And when nominal yields hit less than 140 basis points in July of last year, that represented the lowest nominal yield that the risk-free asset in the world has ever hit since 1285. Now you can imagine that the flip side of that story is that the potential reversal of that bull market can equally assume historic proportions once it really gets underway. Now, my research really, yeah.
Here's the thing, Paul. For years, market watchers have been warning about the bond market ending its bull run. They've always been proven wrong at the end of the day. What's different this time?
Well, I think we are seeing the first signs of really an inflation reversal and a steep pickup in prints all over the world. I mean, just today we had the print from China where PPI now hit 5.5%. I mean, up until last September, China was actually exporting deflation to the world. Now it's steeply picking up exporting inflation throughout the world. We had a very high print from Germany just last week where inflation increased by almost 100 basis points between November and December. Just look at the latest US jobs report where hourly earnings are now growing by 2.9%. And when you look at several precedents just in the 20th century when investors faced the steepest losses for bond holdings, then the inflation reversal type is really one of the ugliest on record. And I compare the current backdrop for the risk-free asset really to the second half of the 1960s when bond investors were faced with a similar combination of fiscal expansion by Lyndon Johnson against the backdrop of the Vietnam War. We had a very tight US labor market. And in the end, within 4 years, bond investors lost and aggregated 36% in real terms in that period. And I think, we are facing rather that sort of scenario than the sort of steep sell-off that we saw in 1994, when actually bond markets returned to a bullish sentiment just a year later.
To what extent, though, Paul, as we see rising inflation, will that then provide something of a cap to growth and also sort of in a cycle here to inflation itself? In other words, if you're going to start to see a heating up of inflation, a heating up of wage growth, won't that then suppress GDP to some extent and also inflation down the road to some extent?
No, I think GDP is still printing at reasonable levels. I mean, the optimism in places like Germany, which provides the equivalent risk-free rate for Europe, is pretty strong. PMIs in the UK, for instance, are holding up pretty well. And I think, if the fiscal stimulus really materializes in the US as well, then to some extent equity investors still have reason to cheer. And I don't think it will necessarily choke up growth if it's combined with the kind of fiscal action in some jurisdictions.
Paul, what can central banks, policymakers do today to limit the fallout from the emerging market bond market reversal?
Well, I think, unfortunately, we have to live with the fact that we cannot undo QE at this stage. I think the best idea would have been not to engage in this kind of unprecedented price distortion that we started after the 2008 financial crisis. Now we have to live with the fact that really investors have been conditioned for years to really misprice the real risk compensation for fixed income assets. When you look at places like Italy, the other European peripheral states, it really becomes clear that the normalization process, one way or the other, will be wobbly, I think. But at this stage, when I look at countries like Japan, when I look at the Eurozone, I think you can contain the fallout by at least withdrawing earlier rather than later from the purchases that are still going on. I think the ECB, for instance, should overthink its decision really to extend QE until the end of 2017 in light of, the fastest rising German inflation since 1993. That's a 23-year high now. You can apply all sorts of nice academic Taylor rules that all will show you that discount rates should be materially higher than they are now. For the Eurozone, the rate is, for instance, 1.3% now. And I think if you start conditioning the market earlier really for a return to market pricing of risk, then at least we can contain the fallout to some extent.
And very quickly, do you see evidence of Draghi doing just that then, conditioning the markets that way?
Well, I don't really think that the decision in December constituted a tapering per se. I mean, of course, we have a really packed electoral calendar in Europe in 2017. I think the decision has to be understood against that backdrop. I mean, you don't really want a fallout in the sovereign bond space by withdrawing too early and then getting an increase in political risk. So to that extent, it's understandable. But really, for investors, it's rather bad news. And I think also the decision to really steepen the yield curve might be good for banks in the end. We have seen banks in the Eurozone rally, for instance. But for For a lot of other people, you know, life insurance, for instance, it's rather bad news. And I think to that extent, Draghi hasn't conditioned the market enough at this stage, I think.
All right, so perhaps he has some work to do there. Paul Schmelzing, thank you so much. Visiting scholar at the Bank of England and PhD candidate at Harvard University's History Department.
And we have some more headlines crossing now from Double Line's Jeff Gundlach, who is sharing his investment outlook via an investor webcast. He says that animal spirits have been stirred by the Trump election. That's something we've heard from multiple investors. He says Trump will lead to a breakout from long-term 2% growth. He said it's a good time to peel off some U.S. stock profits. And he also said it's a good time to buy India stock ETFs. So that's what we've got thus far from that investor webcast. Remember earlier he said that oil will vacillate between $45 and $55 in 2017. Well, coming up, Goldman Sachs, once a skeptic of speed for its own sake in equity markets, is now making a major play for quant funds. More on the firm's electronic trading reboot next. This is Bloomberg. What'd you miss? Goldman Sachs is doubling down on automated trading. The Wall Street firm is trying to attract more quant funds with a sales effort aimed at achieving a top 3 ranking. Joining us for more on this story is Bloomberg's Dakin Campbell. Now, as your story points out, Goldman sort of used to scorn this business. What has changed?
That's right. I mean, to set the stage a little bit, in 2014, when Michael Lewis wrote his book, Flash Boys, Goldman staked out a position against high-speed trading. Gary Cohn, then president, said that market structure as it had developed with a focus on speed was a bad thing. Shortly after all of that died down, they hired a new guy from a high-speed trader and decided, hey, we need to start investing in our stock trading business to be able to handle clients who want to do speed and want to do things fast and want to do trading through computers. So, you could argue or you could ask whether that was just a convenient position for them to stake out when Michael was writing his book, or whether they hadn't done the investment at the time. And so, it's easy to say, hey, we're sort of against the market structure as it stands now, but they've certainly made the decision to reinvest. They've hired this guy a couple years ago, and now they're really going after quant funds. This is sort of phase 2 of their plan. The first one was an investment, and now they're on a sales effort, or sort of a sales plan to to pitch these quant funds on what they can offer them.
Okay, so they're offering to do this. There's this electronic trading reboot. What does this mean in terms of jobs? Are divisions of Goldman Sachs now going to be obsolete?
Good question. That is often what you think about when you think about moving to automated trading. That's not my understanding of necessarily what this means. You know, over the last few years, they've done quite a bit of job cutting and reshuffling of management. In this business specifically, they've hired a couple people in the last year or so, and they've moved a couple other people from other parts of the bank.
So it sounds like it's more an addition of business rather than sort of migration of their existing trading. Is that
yes?
Is that accurate
yes.
to say?
Yeah, that's a good way of thinking about it.
So they're adding here. So why do they want this business so badly now? And what is it about quant funds that makes that an attractive area to be?
Yeah, great question. I mean, we on this show have talked quite a bit about how quant funds are sort of very ascendant these days. You know, in the last few months of 2016, they've had trouble performance-wise, but everybody, you know, from even fundamental hedge fund traders are getting into the quant space. So it's a growing part of the market. Also, these relationships seem to be very much stickier, right? Because quant funds do a little bit of trading every day using computers, and they don't want to have any problems, right? No glitches, no algorithms going crazy. So if they find a bank that they can trust, they stick with that bank, and they're very reluctant to move. So if Goldman can convince quant funds that, hey, our technology is up to speed, you should move some of your business over here, that relationship is going to end up being stickier in the long run for Goldman. So if you can bring some of those guys over from the likes of like a Morgan Stanley, then that means years of revenue.
So how difficult a task is this?
It's tough. I mean, for the very reason that I just mentioned, these funds are very reluctant to move all their algorithms, to move all their trading to these new firms. And, you know, as we've said, Goldman just a few years ago had not invested in the technology, and it was seen as, you know, not cutting edge. So that's why it's a sales effort. You know, it's a process of educating and a process of convincing some of these clients, hey, try us out, move a little bit of your business. If nothing goes wrong, maybe you move a little bit more. Maybe you even think maybe we're better than some of our competitors, and then you move even more business. So they have their work cut out for them. I think they're in a good position. It seems like they're in a good position to do so.
Yeah, we'll see what happens. All right. You'll come back and give us an update. Bloomberg's David Campbell, thanks so much.
Coming up, when good quants go bad, we'll talk about the dark side of algorithms and how they're encouraging discrimination in the workplace in today's Walk the Talk. This is Bloomberg. data can mean big problems, especially when it comes to discrimination in hiring. In today's Walk the Talk, where we focus on social changes that have outpaced corporate America's ability to adapt, I spoke with Kathy O'Neill. She's the author of Weapons of Math Destruction. Kathy is a former Barnard professor and quant at D.E. Shaw, and she says there is a dark side to algorithms that's not being discussed. I started by asking her why she's concerned about the impact of big data when it comes to filtering and screening for job candidates.
What I worry about is that filtering system. Those multiple filtering systems. Are they filtering out people that are perfectly well qualified and sort of unfairly filtering out people? And it's not necessarily true that they are, right? So, for example, if you're looking for a programmer that programs in C and in Python, then it's perfectly reasonable to look for keywords like Python and C. And that is a filtering system, but it's not necessarily unfair, right? So a programmer should know enough to put the kinds of languages that they know onto their resume. But it's gotten much more complicated than that. It's not just keyword searches. It's actual algorithms that go into it. And like many, many algorithms that I talk about in my book, they are just kind of assumed to be fair and objective because of their mathematical nature. But there's actually really no reason to believe that.
Well, because some person had to program the inputs as well. Can you give us some specific examples in which the math algorithms and the inputs that were put in hurts women, the poor, and minorities more than others?
So the example from my book is a personality test, which is not really clear exactly what the definition of success is. But as you say, the people who build these algorithms get to define success. And we can come back to that. But it's their agenda that they're inserting into that algorithm. There's nothing objective about that definition, right? So the personality test that I'm talking about is typically given to like minimum wage work companies. And in order to get an interview, you actually have to pass this test. If you get red lighted on this test, you just don't even get to the interview. And so the question becomes, what constitutes passing or failing this test? And I interviewed a man named Roland Beam, whose son failed this test. And he asked his son, whose name is Kyle, like, Kyle, what happened? What kind of questions were on this test? And Kyle said, well, Dad, they were a lot like the questions that I was asked when I was being treated for bipolar disorder at the hospital. And that's when his father, who's a lawyer, said to himself, that's not legal. Under the Americans with Disability Act, it is illegal to force somebody into a health exam as part of a job application process, that's including a mental health exam. So that's become a class action lawsuit that Roland has filed on behalf of everyone who's ever taken this personality test, this specific one. And on the basis that it violates the ADA.
A lot of different industries use big data. They rely on algorithms. Pro sports teams, for instance, use it to recruit athletes. They might measure someone's vertical leap, their foot speed, all of that. How's what they're doing different from, say, companies' HR departments? Why is it okay for a pro sports team to use data but not CBS?
Well, of course, it's a judgment call in all cases. But the thing I like about the sports example is that everyone sees the data. In fact, that's what we do when we watch sports. We're looking at the data in real time. We argue on sports radio about whether something should have been counted as an error or a base hit in baseball. This is what we do on sports radio, which I listen to way too much. And moreover, it's relatively transparent, like how people are being judged and whether it's working or not. There's a feedback loop. So it's it's both accountable and it's transparent.
As a nation, the U.S. doesn't score especially high when it comes to math and science, right? Beyond the tech and the finance world, people seem to be a little bit scared of math and algorithms. It's kind of something they don't want to touch, in contrast to, say, people in Russia, China, or India. As a result, are we in the U.S. less skeptical of statistics and algorithms and what they might tell us than other countries or other cultures?
That's a great question, and the answer is absolutely. I actually don't know how skeptical people are in other places. I think people in Eastern Europe are skeptical because they're skeptical, period, as people, right? But, for example, I would say that the fear of mathematics and the fear of not being expert enough to push back is absolutely at play here. When we say, oh, an algorithm told me that your score is 15 out of 100 and therefore you are bad at this, people simply just give up and believe it because they're like, I can't push back against a sophisticated mathematical thing like an algorithm. And the point I'm trying to make is it's just an opinion embedded in math. It's an opinion that you can push back against because you can demand accountability, especially if it affects your job or it affects your freedom. Like when it gets important enough, it's tantamount to a law, and you should know what the law is.
That was my conversation with Kathy O'Neill, author of Weapons of Math Destruction.
And we have more headlines. Crossing from Double Line's Jeffrey Gundlach sharing his investment outlook via a webcast. He says that tax cuts and spending hikes do mean deficit expansion. He also says recession is not likely this year or anytime soon. Remember, he also said it's a good time to peel off some U.S. stock profits. Coming up, what you need to know to gear up for tomorrow's trading day. This is Bloomberg.
Coming up tomorrow, don't miss this. President-elect Donald Trump will speak tomorrow in a news conference at 11 a.m. Big day.
He doesn't have those very often. And also, the Trump cabinet confirmations hearings roll on. Rex Tillerson, Elaine Chao beginning their hearings. Jeff Sessions continuing his.
And don't miss this. Earnings season. JetBlue and KB Home both releasing their quarterly results.
And weekly refis as well coming out.
Yes, that's
a lot
right.
tomorrow.
That does it for What You Missed. Thanks so much for watching.
Have a great evening. This is Bloomberg.
I'm Christine Harvey in Hong Kong, and you're watching Bloomberg Technology. Let's start with a check of your first word news. A federal jury has sentenced Dylan Ruth to death for killing 9 black church members in a racially motivated attack in 2015. Ruth faced either life in prison or execution for the killings. The Justice Department says he is the first person to get the death penalty for federal hate crimes. President-elect Donald Trump's pick for Attorney General is on the hot seat today. Sessions says as Attorney General, he would crack down on illegal immigration, gun violence, and the, quote, scourge of radical Islamic terrorism. Senate confirmation hearings for cabinet nominees are being delayed. The Senate will hold its hearing for CIA candidate Mike Pompeo on Thursday instead of tomorrow. The hearing for Betsy DeVos, who was President-elect Donald Trump's choice for the Education Department, will be next week. And the hearing for Andrew Putzer to be Labor Secretary may not happen until February. And President Obama makes his farewell speech tonight, but he won't be speaking at the White House. The president will deliver his address from his adopted hometown of Chicago. And you can watch President Obama's speech tonight on Bloomberg TV. Coverage begins at 9 p.m. Eastern at 10 a.m. in Hong Kong. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Christine Harvey. This is Bloomberg, and Bloomberg Technology is next.
I'm Caroline Hyde. This is Bloomberg Technology. Coming up, London snatches Snap. Why the social media giant is banking on the UK ahead of its potential $25 billion IPO. Plus, the Jeff Sessions files. The first of Trump's cabinet picks answers tough questions on Capitol Hill, covering encryption, immigration, and Hillary Clinton's emails. We break down the headlines. And Alibaba's offline bet. Jack Ma is betting $2.6 billion he can revamp China's retail industry. But first, to our lead. Snap Inc. has named London as its international headquarters. The parent of the popular Snapchat messaging app also said it will pay British taxes on sales booked in some overseas markets. Now, it's a surprising move for a US tech company. Most Silicon Valley firms are known to look to Ireland, to Luxembourg, in order to get advantage of more favourable tax rates. But in recent months, this practice has US tech giants under scrutiny. EU Competition Commissioner Margaret Vestager spoke exclusively with Bloomberg on Monday regarding protecting competition.
What we're aiming at is behavior. For instance, the thing that happens if one company or a group of companies are given state aid which is not available to other companies. That seriously sort of unlevels the playing field. That disables fair competition.
So, smart move by Snap? I pose that question to Bloomberg Technology reporter Adam Satariano, who's based in London.
They're kind of formalizing something that's been going on for a little while. They've been staffing up a lot in London over the past year. They're up to 75 people in the city, up from 6 the previous year. But having this as their tax hub is unusual because a lot of tech companies have been putting themselves in Ireland and Luxembourg to take better advantage of lower tax rates. Apple, Amazon, Starbucks, McDonald's, a lot of other companies have been touching on regulators' ire as a result of that.
Exactly. Is this potentially a reaction to how we've seen, in particular, the European Competition Commission react to some of the tax arrangements the likes of Apple, for example, had in Ireland?
Yeah, I think a lot of companies have been spooked by what they've seen from the European Commission and other regulators going after some of these tax havens. But at the same time, we shouldn't sort of put Snap on a pedestal too much here. I mean, the tax rates in the UK have been coming down. There's some optimism among some business leaders that tax rates would come down even further as a result of that vote. And so they could be trying to get in a little bit ahead of all that.
And certainly an upside for the United Kingdom amid what a lot of uncertainty surrounding the Brexit vote last June.
Yes, certainly. But for Snapchat, this is a logical hub because the global advertising industry is really headquartered in New York and London, and since that's a big part of their business, it makes sense for them to have such a big office here. They've opened up a shop in the Soho neighborhood. They have one building already open, and they're looking for another one.
And is this expansion a slight race ahead of what is expected to be their initial public offering coming as soon as March this year?
Yeah, Evan Spiegel, Snap's CEO, a big part of his pitch to investors for this IPO is going to be the company's global opportunities. It's clearly done well in the United States, especially with younger people. But to justify that valuation, which is said to be $25 billion or more, they're really going to have to show that it's going to resonate in other countries. In Europe, they have about 50 million users, 10 million in the UK. And so that number is going to have to continue to grow quite rapidly to justify that high valuation.
Bloomberg's Adam Satariano there. Now, let's get an investor's take. Now, as Snap expands ahead of its hotly anticipated IPO, what do money managers, what does Wall Street want to see from the burgeoning social media camera company? Here with me, Sunny Dillon, founding partner at Signia Ventures Partners. Welcome to Bloomberg Technology. UK headquarters in